Hello, everybody, and welcome. This is problem 1712. So just as kind of like a word of note, I'm going to probably be doing this slightly differently than the way that the solution in the textbook is being done. And it really just has to deal with this very end part over here. But we'll get to that in just a moment. The first thing I want to talk about, though, is the difference between what is a call option versus a put option. Okay, and so right over here, the call option, right over here. So a call option gives the buyer the right, but not the obligation to buy the underlying security at the exercise price or within a specified time. A put option gives us the right to sell the underlying security at a certain price or within a specified time. So really, if you're doing a put option, you're really kind of betting that the stock price is going to drop, because if the stock price, say, so right over here, so if I'm able to sell it at 70, I want the price of the stock to go lower, because then I could basically sell it at 70 and buy it at the current price. Whereas with a call option, I'm betting for the stock to be successful. So I'm just going to put this right over here so you can kind of take a look at this. Put versus call option. Okay. So the treasurer of Miller Company has read on the internet the stock price of Wade is about to take off. In order to profit from this investment development, Miller purchased a call option on Wade for $240. Okay, so we're going to have call option time value, call option fair value. Okay, so when we buy the option on July 7th for $240, I am debiting call option time value, and then I would be going through and I would be crediting cash. So let's go through and record that here. So this is going to be 7/7/20 count. So this is going to be call option time value cash to record purchase of call option. Note, with all these ones, I'm breaking this up into two different accounts, just because for me, it's easier to kind of visualize what's happening by showing this over here is the time value, and then over here is the fair value, which is really going to be talking about the increase in the shares. So our first date over here, and when I buy this, this is all I'm doing. Okay. So I've done the investment on the call option. I prepare financial statements. Now, when I prepare financials and I don't sell the option or don't exercise it, there's going to be two things that are going to be happening. The first one is on 9/30/20. My call option time value is 180. So what I'm going to need to do is I'm going to need to adjust the call option time value by 60 to reflect that time that has basically gone through and expired. And I'm going to be debiting unrealized holding gain or loss income. So this is to record the time value. Okay. So that's the first thing that I do. Now, because my basically my strike price is at 70, meaning I can buy it at 70, the market price is right now at 77. So if I can buy it at 70 and sell it at 77, this would be a gain per share. So the fair value of this call option on 9/30/20 is going to be at $7 per share. I have the ability to purchase 200 shares. So the fair value is going to be over here at 1,400. And if I was just to use this, okay, so this is how I'm coming up with my various numbers over here. So my call option fair value as of September 30th is going to be 1,400. And before I go any further, my call option time value, I'm crediting this for 60, and I'm going to be debiting the unrealized holding gain or loss for 60. Okay, it's unrealized because I have not gone through and sold it yet or settled it yet. So my call option fair value is at 1,400, right? When I initially bought this, this market price was 70, the stock price was 70, so there was no fair value of this as of July 7th. So over here, I'm going to debit call option fair value for 1,400, and I'm going to credit the unrealized holding gain or loss on the income for 1,400, and this will also be on 9/30. Okay. Now, that's it for September 30th. Now we get to December 31st. So I've got two things going on. I've got the time value, which the time value of my call option is now at 65. So over here, it's at 65, and this is as of 12/31. So I need an adjustment here of 115. I'm going to credit the call option time value to reflect the time value here. I will go ahead and debit my unrealized holding gain or loss for 115. Okay, so first entry, and it's going to look exactly the same right here. I'm debiting unrealized holding gain or loss on the income. I'm crediting the call options time value. So right over here, it's going to be 115 and 115. The next thing I need to do is to perform a similar analysis in terms of what is the value, or what is the call options fair value? Well, at December 31st, the strike price is 75. Option price is at 70. Gain or loss per share, it still has value. But as of December 31st, this call option fair value is now at $1,000. So what I need to do here is I need to go through and I need to make an adjustment. My adjustment is going to be for 400. If I'm crediting the call option fair value, I'm going to go over here and debit the unrealized holding gain or loss to get to my amount. So whenever we're looking at this, the opposite as we're going through and doing the valuation will be to the unrealized holding gain or loss. Okay. Now, so that's the time value. The fair value is I'm debiting unrealized holding gain or loss. And this is going to be for 400. Okay. Now, for the fun part, which is always, accounting is always fun. Our fun part over here is that, so I prepared the financial statements. I would be showing the total value of the call option is going to be 1,065. Financial statements over here, basic call option value is going to be 1,580 on September 30th. I would just add these two values here. And in terms of the unrealized holding gain, net on 9/30 would be 1340. And then for the 3 months ended December 31st, it would be a loss of 515. Okay, so now I'm settling this. I settle the call option. Now, when I settle the call option, the time value of this is at 30, and this is at 1/4. So the first step we're going to do is we're going to go through and record basically the change in this time value. So right over here on 1/4/20, I'm going to go ahead and because this unrealized holding gain or loss on income, this would be 2020. For 2021, we would need a new T account. And let's go ahead and do this. So over here for 2021, that would be closed out to 0. Okay. So here I'm going to have a credit for 30. No, sorry. I'll have a debit for 35. And this would be on January 4th. Okay. So I've taken care of the change in the time value. So this over here is going to be I would be debiting unrealized holding gain or loss, crediting time value, 35, and this is to record the expiration of the time value. Okay, now I've got that done. So what is this option on my books for right now? It's on my books for 1,030. So I'm now going to go through and settle the option. What exactly does that mean? Well, on 1/4/20, right? If I'm selling it at 76, and we can just use the same, borrow the same format over here. If I'm selling it at 76, 70 is my option price. My gain per share is $6, 200 shares. The fair value of the call option is going to be 1,200. But now what this is going to become is that the cash I'm going to be receiving on 1/4/20 is going to be this gain per share times the number of shares. So when I settle it, I'm going to be getting cash of 1,200. Okay, and this is going to be 200 shares times the difference in my current share price and then my option price. Okay. Now, what I also need to do at the same time is I've settled this. So I need to get rid of the call option time value. This here had a balance of 30. So I got to take that down to 0. And then also here, I've got to get rid of this fair value over here at 1,000. So I'm going to have also call option fair value over here for $1,000. Okay, so the next thing I'm going to go through here and do is lastly, as I'm going, okay, I've got debits of 1,200. I have credits of 1,030. To balance this, I'm going to need a credit of 170. This is going to be my gain on settlement of the call option. Now, what your book does is that they true it up, meaning that they show this as 1,200. They would show a gain, an unrealized holding gain of 200 coming through, and then they're showing a loss of 30. But if you go through and you read that, if you go through and you read the book, that's something that you can kind of go through and see. Okay. So that's January 4th. It's exciting, okay? So that is problem 1712. Let's look at problem 1713. Now, I put a put option on Ewing common shares. I paid $240 The put option and the strike price is 70. Market price of the Ewing stock on that date is 70. So because I have the right to sell the shares, what I want to do is I'm hoping and praying that this goes down, right? But for us here, this is not going down, it's going up. So it's going to be a little bit easy for us to kind of go through and do. And let's check this out. Okay, so I have over here my call option time value right over here. And this is 1713. And let's take a look here. So I purchased a put option for 240. Strike price is 70. Option expires on January 31st, 2021. And I didn't want to do that. Let's just make this bigger. Okay. Okay. So right over here, I paid so I paid 240 on literally the same date. Okay. So what I would do here is when I buy it, this is how I would go through and record it. I would have call option time value. Okay, and then I'd be crediting cash, and this is to record the purchase of the call option. Now, the time value of the put option as of September 30th is going to be at 125. So over here, I'm going to have an adjustment of 115. So this is going to go to so on September 30th, this is going to go over here to be at 115. So at 9:30, right, I'm debiting unrealized holding gain or loss on the put option, crediting the call option time value over here for 115. Okay. Now, the reason why there's no fair value change is because if I had to sell the shares at 70, I wouldn't buy it at 77 or I would be running at a loss. So there's no fair value in this. The only time you would have a fair value on a put option is that if the market price went down. Okay. So right over here so the time value for the put option at 12:31, and I'm not going to have any fair value because none of these share prices went below 70. So over here on December 31st, it's now at 50. So my adjustment here is going to be at 75. Okay, so 12:31. Okay, I'm just going to essentially keep on trucking, keep on recording this same entry. And this will here be at 75 and 75. And my next one over here is on, it expires, right? So I didn't do anything. So the put option expires. So my last entry over here would be on 1/31. It's now at 0. So this would be 2020 for 2021. 1/31 would be 50. So 1/31/21, I would be doing the same entry. Again, this option has no fair value because the stock price never fell below 70. So And again, if you want help in terms of understanding what is a put option or what is a call option, that's the difference between those two. Okay. All right. So I want to thank you all for joining me here today. In this, I guess I've got an anonymous Nyan cat that is hanging out on my Google Sheet. So if that's you, good evening. And I look forward to seeing you on the next video. Have a great one.